By now, all of your kids are back in school, the market is ticking, and we probably know about the third potential rate drop that is happening here in Canada. And we're coming out of a summer, kind of a slump. Things really weren't that great. We saw some prices decrease, we saw inventory go up, and is the market fully changing? It kind of is and it kind of isn't. So we're gonna dive into that. We're gonna talk about a lot of things, but first, I am enjoying creating content for you that is all about interviews. I want to talk to recruiters. I want to talk to those that are in the know about jobs. I want to talk to those that know about infrastructure changes that are happening in our city. So please, if you know someone or it is you, I would love to have conversations. Reach out at our email, info@chamberlaingroup.ca. I and my team get those emails and we respond to them. So please reach out as I want to do that. But let's talk about the stats. So to start off, the city had $601,800 as its benchmark price coming into September. That is a 6.3% increase year over year, but a 0.81% decrease from July 2024. Now, the detached properties, we saw a $762,600, which was a 9.5% increase from last year, but a 0.68% decrease from last month. Semi-detached properties saw a $681,200 benchmark price, which is the same as detached, about a 9.6% increase from last year, and a 0.97%, so almost 1% decrease from last month in July. Row homes, townhomes, they're sitting at $461,700, which was a staggering 12.5% increase from last year, but that's down about 0.5% from last month. And apartments, we basically saw a $346,500 benchmark price, which is even more staggering because it was a 15.8% increase over last year, but only a 0.06% decrease from last month. So all of these numbers we are seeing decrease slightly. They're pretty much the same over the summer. We haven't really seen the effects of more inventory, a little bit less sales, and just the changes that are happening. They haven't affected the prices in the market yet. Will they? Probably. If we see more inventory coming, the supply to demand, that thing is going to shift a little bit. There's more, developments being put in the market too. So there's new projects that are finally being finished, new condos, townhomes, houses that are now on the market from the new home market. Those are now being eaten up and taken, and some of those are going back on the market because the people who bought them 2 years ago aren't planning on living on them. So that's also adding to the inventory increase that we are seeing in our market right now too. The total number of new listings that we saw last month in August 2024 was 3,536. This is a 13% year over year increase, but it's actually a little bit of a decrease, which was 3,604 that we saw last month. So the total inventory for our city was sitting around 4,487 as we walked into September. And that is an increase of 37% year over year. And last month we saw 4,158. So it is increasing month over month as well. Now the months of supply, this is the first time the whole city has actually climbed over 2%, I think in probably well over a couple of years or a year and a half. I don't have the number right in front of me, but it has definitely been a long time since we've seen that number. Last month we were sitting at 1.75 months of inventory, which now we are sitting at 2.05. So if you remember, anything between 2.5 and 4 months is a balanced market. So we technically are still in a seller's market in Calgary, even though we're seeing all of this more inventory, sales, all the things that are changing, prices adjusting, we're still sitting in a seller's market, just not nearly as strong. So that means there are some pockets of price points and different product types that are sitting higher and probably in a buyer's market. So we're gonna dive into those stats so you can see some of the inventory numbers. But first, Let's take a look at this. So I want to show you the stats on a chart so you can visually see what I'm talking about when we're looking at this. So 4487 was the inventory we had. Last month was 4158. You can definitely see a pattern of increasing in our market right now. However, overall, we're still well below long-term trends. I mean, look at all of these years that are sitting up there, much higher. Some of them sitting around that probably 9,000 listings. So I believe in order for our market to see a balanced market or even go into a buyer's market, we're gonna have to potentially see 6,500 to 7,500 listings inventory, right? Total inventory in our city for it to actually make a change. So we have a long ways to go to still get there. Can we get there? Maybe. If things keep going this way and things keep shifting the way that they are, we could see that. I don't fully know, you don't fully know, and I'll share with you my reasons for that in a moment. When we look at new listings per month, you can see we are now finally adding more listings than the trends over the last 10 years. So 3,500 new listings are coming onto our market right now. Now, do I think that this is going to go up? I don't believe so. I believe we're gonna follow this pattern that seasonally happens in our market. We probably will see a similar number as we go into September and October, which will kind of push our total inventory up. Because if sales are not moving forward or higher, then that's just gonna add inventory to our market. Because if you look at, we had new listings was 3,500 and we had sales at 2,100. Essentially, that's 1,900 listings that came to the market that never got eaten up. So that's adding to our inventory every single month. Not totally by 1,900, weird stat, doesn't make sense, doesn't add up. But you can see that we're not removing listings like we were before. We're not selling more than what's coming on the market. There is product that is staying on the market. If you like stats and you want more information, more data, then go to the link in the description, get this guide that we have, because we have all of the sub-cities around Calgary, all the product types, way more information in there that's going to help you and have the knowledge that you need for when you're making decisions in our market. But let's get back to the data. So what you can see in this chart is something we haven't seen in a while. So take a look. Back in 22, we started to see a gap rise, similar to the rise that we are seeing now. Here's what's different. This was going into the spring market. This is going into the fall market. Completely two different markets. A fall market is typically not as strong as a spring market, but at the end of the day, we're seeing a similar pattern, but at completely different times of the year. Because as we go into the fall market, usually we end up seeing a tick up. We definitely, for sure, sales are strong, things are there, things are good, but then it goes into winter and then spring happens. Springtime doesn't happen when the flowers happen. I've seen it over my 20 years of real estate happen anywhere from literally the first week of January all the way till it being delayed till June. So it really is market sensitive to what's happening in the market, the economy, what's happening with interest rates. A lot of different variables kind of change that timing for Calgary's market to start in the spring. So we have months ahead that aren't the peak season of selling, and we're adding inventory to it, so that inventory probably could stay on longer. And is the spring market gonna be strong enough to actually be the best time to sell? There could be a lot of inventory, prices could drop, but I'm gonna make a video on that shortly. So is it better to sell now or is it better to sell in the spring? Stay tuned because we're gonna talk about that more. The other thing I want you to see on here is this is a little bit of a dip in our pricing. Our pricing has adjusted downwards a little bit. And it's not the first time and it won't be the last time, but I do believe that our days of shooting up in big increments is probably coming to an end. We're not gonna see these massive boosts probably over the next couple of years is my gut. My gut is saying we're gonna have ups and downs. We're gonna have overall over the next 2 years, we're still gonna have some slow growth or some kind of straight line numbers. We're not gonna see these another 50,000 or another 75,000 or even 30,000 jumps over a couple of months. The market, the economy, the country, our city, we're all just kind of sitting in a different place than we were 2 years ago. And so when we talk about the months of inventory, this is where I was saying, right here to here. That is your balanced market, 2.5 to about 4 months of inventory. We're still down here. However, we are on a sharp upward trend of getting into a balanced market. So I do believe that we could actually see a balanced market as we head into October, November, and for sure into the Christmas months. There's no reason that we're not going to see that. So as we move into the following months, we are most likely going to see interest rates dropping. There's a lot of negative news about the economy, looming recessions, things that are just kind of out there that aren't the best for our world. In terms of jobs, in terms of incomes, in terms of affordability. There's so many things out there. By the time you're watching this video, I'm shooting this on Tuesday, September 3rd. They have probably already announced an interest rate drop from the Bank of Canada for basically variable interest rates.
So the Bank of Canada has settled on a third 25 basis point cut in a row to ease the burden of high borrowing costs.
Unemployment is rising, wage growth is slowing, and job opportunities are getting slimmer. All of these things are contributing to the Bank of Canada adjusting that interest rate because there's pressure on them to do that. There's a ton of mortgages that are coming for renewal up between now and up to probably 2026. So there's a lot of pressure on the Bank of Canada to get this right so that there aren't people who are going into a negative. So markets are currently expecting 5 rate cuts in 2024 for a cumulative of 1.25% reduction in the Bank of Canada's policy rate. So by the end of this year, there is a very good chance that rate could be sitting at 3.75%. Currently, if they did the rate this month, which I think they did, we should be sitting at about 4.25. Now, where's it gonna go from there? Well, I've seen a multiple people, economists, interviews, things that are talking about we could see as low as 3% in 2025. This all just depends on all of these job numbers, all of the inflation numbers, all of the things that are happening in our economy to create where we are at. I mean, let's be honest. You can't throw a ton of cash into our economy that the government did and not expect things to happen the way that they're happening. Now, that's going to affect prices, that's going to affect jobs, that's going to affect, and that's just not in one place or another, it's going to affect everything. In Calgary, we are sitting in a little bit of a different scenario. It's not that we're going to see massive increases when the rest of the country is seeing decreases, that's totally not it. Where we are probably going to see a little bit of a difference is we have a little bit of a buffer because our prices are still very affordable compared to other places. Now let me show you that. So RBC has an affordability index that they've been keeping track of since the 80s. And what this index is it's the ownership costs in a percentage of the median income pre-tax dollars for those that are living in those cities. So what's very interesting is they've been keeping track of this since the 1980s, and they have some historical data. When you look at this data, Canada at first is sitting at 60.9%. That is where all of Canada is currently. Now, again, you're gonna have 3, maybe 4 that are really skewing that stat because of how big population is. The first one is Victoria. It's not a big area, but look at that, it's nearly 75%. Their historical is under 50%. They have jumped massively, become very, very unaffordable compared to what their historical is. Vancouver, we all know Vancouver, they're actually sitting over 100%. Theirs is actually, I believe it's 100.9%. That's insane. All of your money is just going to your house. So then there is Toronto. Toronto is sitting at 78.9% for their costs of percentage of median incomes for that area. Now their historical average is 50%. That is also a massive jump compared to the historical averages there. There are other cities that have really big gaps from their historical. Ottawa, that's a big gap. Montreal, that's also a big gap. Halifax, that itself is a really big gap. And where there is not a gap compared to the historical are places like Calgary, Edmonton, Saskatoon, Regina, Winnipeg. You see what I'm talking about? Even though Calgary's prices have jumped so much, the affordability index is still saying that 43.5% of the median pre-tax income in Calgary is only going to cost of living and ownership of that property. In Edmonton, it's actually at 35.5% because Calgary's historical average is just under 40%. So this one thing here that I have watched for years, it really gives us a buffer. This is still the reason that I believe, and I know you are going to look at it and say, well, prices have gone up and there's going to be keyboard warriors going into the comments and going to be like, you're wrong, blah, blah, blah. That's fine. This is the data. This is what it's showing. And this is where that buffer is going to come. Because the population of those other places are still, many people are still looking for affordability. Doesn't mean they're going to move quickly. What it means is that Calgary is now an option for those people when they are ready or are needing an alternative. That's just not people coming from other cities, that's from international as well. Calgary is now an option. Calgary is now considered a place where those people can come. So we are probably going to see massive drops in our pricing, in our values. We're probably going to see much more of a balanced market moving forward. And frankly, I welcome it. I think it is a great place for our city to be. With the growth that we've seen, let's slow things down. Let's have a balanced market. Let's wait. Let's figure this out over the next couple of years. Let's not have all of the fear of missing out and the multiple offer sagas that are always happening. Let's just kind of chill. Let's figure this out. And I honestly believe that's where we're gonna go. This morning at 10 a.m., Santa's coming, right?
Okay, people, tomorrow morning, 10 a.m., Santa's coming to Santa!
I pulled all of the actives and the pendings in Calgary. There was a total of 4,480 actives and pending properties that were on the market. Now, out of that, there was 1,717 detached properties. There was 283 semi-detached. There was 526 row homes and 1,274 apartments. I'm gonna actually throw up the raw data. You can take a look. If you wanna dig into it, pause the video, come back to it, but I'm gonna keep going. What I did is I pulled the new listings, the price decreases, the back on market, and price increases. Yeah. Actually, there was a total of 71 price increases as of this morning. Those people are very hopeful. That's good. First place was semi-detached. 66% of the 283 properties here are new listings. Second place goes to row houses. These two brought the most inventory to their product types. Now, detached properties, they brought in 59% and 58% for apartments. So they weren't really that far behind, but those two are the top categories or the most listings for their product type. Now, what I also learned, where were the biggest price decreases percentage-wise? Well, that came in for detached and apartments. Detached properties was about 34% of all detached homes had a price decrease. and that is they're still active, but that's their last status change on the market. And 34% for apartments as well. Now, semis were about 25% and 30% for row houses. Now, when you look at the inventory, all of the inventory for the last 4 years is broken out in price points for the city. Now, blue lines is August 24. So if you were to take a look at this chart, every price point, all of them, except for under 300,000, inventory went up compared to last year. So when you look at that, you could easily freak out, right? We have to remember this is all product types. Homes that are affordably priced or starter detached homes, for example, it's not the same scenario there. So let's take a look at this. This is detached properties. Where you see a large increase in detached homes for the inventory is between 7 and $1 million. Like that one product price point is really jumped. I mean, look at that. That is wild. However, we've actually saw a decrease from last year between the 5 to 600,000 range. And we saw a slight increase between 6 to 7, but homes that are under $600,000, there's still a shortage. That is a really tough price point. And so if you have a home that you're thinking of selling, I mean, prices could drop over the next year. So selling this fall could be something that's really important to do to kind of keep that value, because there is a shortage of homes under that 650,000 price point. Now, what about townhomes? We saw something similar with that. However, the increase went between this is semi-detached, was a big increase between 6 and 700, and there's an increase between 5 and 6, but then between 7 and $1 million, it's kind of the same. Detached homes, there's not that many of them. There's still a lot on the market, but compared to the other 3 product types, this one's much smaller, so it doesn't affect our market as much. Now, when we get into townhomes here, this is where we are seeing a big difference. Townhomes between $400,000 to $500,000 and $500,000 to $600,000, that is 2 blue lines sticking up, right? They are massively increased in inventory in that price point compared to last year. Now, again, we're not in a buyer's market. There's not too much inventory on our market. But compared to the last number of years, this price range has really jumped. Where the under 400,000 mark, between 3 to 4, it's gone up, but it hasn't gone up nearly as much. And now when you look at apartments under, well, actually between both, between $300,000 to $500,000, there is a lot of inventory that has gone on the market compared to last year and years prior to. However, any apartments that are between $200,000 to $300,000, there is a shortage of those. So that too, if you have a detached home that is under $650,000, there's still a lot of buyers willing to jump on that because of its price point. If you have an apartment condo that is priced under $300,000, there's a lot of buyers that are ready to jump on that. Doesn't mean you get to ask exuberant prices for that market and what's happening, but there are some very interesting stats here. So when you look at the city overall and you see every single price point increasing in inventory, that's not necessarily what is happening. You have to dig into the details, and details is exactly where you're going to find in this video here. So go watch that for more stats compared to this month, and we'll see you over there. Oh, and don't forget to download the market report because tons of good info in there. See you guys later.